Dear students, we will do a new module, module 70. This is about computation of capital gain. All the adjustments we have included, and I have divided it into three parts. Part 1, Part 2, Part 3. Computation of capital gain, Part 1, Part 2, Part 3. In each module, I will explain two problems. So in this module, I am going to explain two problems. So first problem, Mr. C sold his residential house on 1/7/24 for 20 lakhs 50,000. This is the value 20 lakhs 50,000. Now, expenses on transfer is not there, which he had purchased on 1/2/2002 for 4 lakh 10,000. So, expenses on transfer is not there. So, this is the net sale consideration. Now, we have to reduce index cost of acquisition less index cost of acquisition. That meaning 4 lakh 10,000 he purchased, but he had spent 56,100 in 2003-4. CII is 109 on the modification of the house. He had agreed to sell the house to Mr. K and received an advance of rupees 10,000 in the previous year. So this adjustment you have to remember, up to financial year 2014-15, advance money forfeited. Meaning is they entered into an agreement, but the transaction has not happened. So the seller is retaining that amount. Up to financial year 2014-15, the tax treatment was, it will be subtracted from the cost of acquisition. So in this case, 4 lakh 10,000 minus 10,000. So cost of acquisition will become 4 lakhs. 4 lakhs into 363 divided by 2002. That 100 is the index. So this will be the treatment. From financial year 2015-16 onwards, what they have to do is the advance money forfeited. We will not deduct from cost of acquisition, or we will not do any adjustment in capital gain. It will be treated as income from other sources. It will be taxed separately. So you have to remember that both the adjustments I have explained, because some universities are following the old scheme, some universities are following the new scheme. So you have to remember that. So here I have deducted based from the cost of acquisition. Now modification of the house also we have to consider. Now he had agreed to sell the house to Mr. K and received an advance of rupees 10,000 in the previous year 2005 and 6. But the transaction was not materialized and the amount was forfeited by Mr. C. So that is what we have subtracted. You can also avoid this and you can write a note saying that from financial year 2015-16 onwards, this is treated as income from other sources. Compute the taxable gain of Mr. C if he bought a new residential house property on 1/11/24 for 2,50,000 and invested 1,20,000 on 1/12/2024 in National Highways Authority of India funds notified under section 54 EC. Within 6 months they have to invest. So the date of sale is 1/7, July 1st, 24, and he has invested on December 1st in National Highways Authority of India. Then only he is eligible for exemption under section 54 EC. So this is within 6 months we can allow that. Now we have to compute. So I have explained net sale consideration, cost of acquisition, index cost of acquisition. When you do this, you will get 14 lakhs 52,000. 14 lakhs 52,000. 14 lakhs 52,000. Now index cost of improvement. Index cost of improvement 56,100 into 363 divided by the cost of acquisition. That value is index is that index is 109. So that value is 1,86,000. 1,86,828. 828. So these two values we have to reduce from net sale consideration, then you will get the LTCG. LTCG value is 4,11,172. Now he is eligible for exemption because he has invested in new house property. So that is under section 54. 54, new house property he has invested 2,50,000. Then he has invested in National Highways Authority of India within 6 months. So that is 1,20,000. 1,20,000. So both he can claim. So taxable LTCG. Taxable LTCG. this value minus these two values. So taxable LTCG is 41 lakhs 172. So this is the first problem I wanted to explain. Second problem is simple. Second problem. Compute the taxable capital gain of Mrs. J for the assessment year 25-26. Cost of acquisition of residential house in 2001 to 4,90,000. So that is the value we will consider because it's the 2001 value. Sale proceeds as on 2/6/24, 23 lakhs. Cost of construction of new residential house in 24-25 and used by his sister for self-residence. So here you have to remember, within 3 years he can construct. So he sold it on June 2nd, 24. But he has constructed new house property, so he can allow for exemption. So CII for 2001 and 2 is 100, 24-25 is 363. So net sale consideration 23 lakhs. There is no expenses on transfer. So this is the net sale consideration. Now less index cost of acquisition 4 lakh less index cost of acquisition 4,90,000 into 363 divided by 100. There is no cost of improvement. So that value is 17,78,700. 17,78,700. So long term capital gain. No improvement is made to the house. So the LTCG is 5,21,000. 5,21,300. Now he has invested in investment in the new house property. Whether self is used by sister for self-residence, it's the house property in his name, he is eligible for exemption. So less exemption under section 54. Under section 54, 4 lakhs. So here 1,21,300. That is the taxable LTCG. Taxable LTCG 1,21,300. So this is what I wanted to explain in this module. Happy learning. Thank you.